Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I'm Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 1 in our series for 2025, and today's date is Friday, February the 7th. First, I'll be talking to the US-based CEO of Bionomics, Spyros Papapetropoulos. Bionomics is distinct in two main ways. It specialises in mental health disease drugs, especially anxiety, PTSD and dementia. Also, it has the most blue-chip ownership you could get for a small-cap Aussie biotech. And I'll be talking to AMP Capital Chief Economist Shane Oliver about inflation, interest rates, and what global economic trends we can expect in 2025. But first, let's talk to Spyros Papapetropoulos.
Well, Spyros, could you give us an idea of the scale of social anxiety disorder and PTSD?
Absolutely. I would be delighted to. So social anxiety disorder is also known as social phobia. And what it is persistent fear of social and performance-related situations. So the most common type of social phobia is fear of public speaking, or actually fear of public places altogether. So this social phobia or social anxiety is very common. It affects about 10% of the population worldwide, both in developed and other areas of the world. And one of the highlights is that it's typically a condition that affects younger individuals, children, adolescents, and young adults. So very rarely a middle-aged person is diagnosed with social anxiety disorder or social phobia. Typically, this is something that lingers on over the years. And you can appreciate how important social anxiety is, particularly as we're in this post-COVID era where people were locked up for a couple of years at least, and now they're re-entering society and having to deal with their fears of re-entry. It's also very important because of social media and the pressure that the social media are putting in the younger individuals. And this pressure is only going to increase. So you can imagine people with social anxiety disorder are forced to restrict their activity. They restrict their jobs, their performance. They face challenges with relationships, family gatherings. They cannot go out shopping, things that we take for granted, they cannot necessarily do. And prolonged social anxiety, if left untreated, has a lot of complications down the road. It leads to social isolation, comorbid depression, suicidality, and even addiction. So a very, very important indication and an area of high unmet need for new and effective treatments.
Now, what are some of the current treatment options available for people suffering from social anxiety disorder? Why has there been no FDA-approved treatments for over 20 years?
Well, this is going to take me a minute or two to go over. It's a very important question. So there are approved treatments, as you mentioned, and there are approved treatments for about 20 years. And these are the typical antidepressants. So what we call the selective serotonin or norepinephrine reuptake inhibitors, also known as SSRIs and SNRIs. What these do is they increase the amount of serotonin and norepinephrine in the brain. Now, these medications have a very slow onset of effect. So it typically takes about 30 days for this medication to start working, and they have to be taken in a daily basis. And most patients do not experience long-term benefits from this treatment. So only about 30 to 40% actually respond to this treatment. Another important element here that I need to mention is the increased risk of suicidality while you're on this treatment if you're a young individual, particularly an adolescent. So there is a very important risk associated with taking these medications. There are others that are taken what we call off-label. So they're not officially approved, but they're approved for something else, and people use them for the acute treatment of social anxiety. And you might have heard, or your listeners may have heard, a type of medications called benzodiazepine.
Yep.
Valium,
Yes.
Xanax,
Yep.
very, very well known and very effective in actually treating acutely anxiety in patients. However, they're very problematic for many different reasons. One is the risk of sedation and drowsiness. And the second and most important is addiction potential. So they're not to be taken chronically. So here we have an old category of a category of antidepressants that take longer to kick in, and they're not as effective, and something that is very effective, but it's not to be taken for longer. And when taken, you feel sleepy, drowsy, and sedated. So the need for what we call a non-sedating and non-addicting anxiolytic is the holy grail. And this is definitely going to transform the treatment paradigm.
Now, Bionomics solution is the BNC210. Now, this targets a different mechanism of action from approved therapies. Why might this be better suited to treat these disorders?
Yes, absolutely. So in a nutshell, BNC210 acts on nicotine receptors. This is a very established target for the treatment of neuropsychiatric disease. And it targets a specific nicotinic receptor called the alpha-7. And what it does, it modulates its action negatively. It doesn't block it, but it modulates, it reduces the activity of this receptor. This receptor is very active in areas that are highly important for the generation of anxiety. And your listeners may have heard the term the amygdala. This is where fight or flight is initiated. It's a very common organ in most mammals. So this is exactly the area where BNC210 acts and restores the excessive activity that is causing anxiety. And how do we know that? We know that from clinical trials, because actually there are imaging methodologies using functional magnetic resonance imaging that can actually measure and capture the activity of the amygdala, while a patient with anxiety disorders actually experience a fearful stimulus, such as a frightening face, shown to them while they're in the MRI machine. And this can be nicely captured. So this is the promise that this potential future therapeutic holds. And what is differentiating here is the safety profile or the side effect profile. So the profile of BNC210 so far is very similar to placebo. There is no evidence that it causes sedation, drowsiness, somnolence, fatigue, or there's no evidence from the current work that it has addicting potential.
Now, how is the company's phase 2 trial in PTSD progressing?
Well, the trial was overall a very informative trial. So there are many examples of therapeutics that, in phase 2, they go through a experimental testing that actually reveals the benefits and the profile of the drug. This is exactly what happened with BNC210. So after we started analyzing the data, we realized that the profile that we initially believed was associated with BNC210, and it was somewhat limited to just the performance of a task, of an anxiety-inducing task, such as public speaking, was not limited to just public speaking or just the performance of the public speaking, but the effect was also present in anticipation of doing the task. So if you look at the anxiety levels of a patient that participate in our trial, across the board, you see a reduction both in the anticipation of performing an anxiety-inducing task, but also during the performance of anxiety-inducing task.
Now, Bionomics has a licensing agreement with Merck and Company Alzheimer's disease and other central nervous system conditions. Can you briefly outline the agreement and status of the trials?
Yes, absolutely. Our ongoing strategic collaboration with Merck is to develop positive allosteric modulators of the alpha-7 receptor. So exactly the opposite of what BNC210 can deliver. And this mechanism is tightly associated with improving cognition, both in Alzheimer's disease and other indications. So these are the programs that are covered under our agreement with Merck. Merck funds all the research and clinical development costs and is responsible for the global commercialization of any potential therapeutics in the future. We have received $30 million so far in milestone payments, and we're eligible to receive more The total package can be up to $506 million over the years, both in milestones and royalties. So Merck is currently in phase 1 with 2 clinical candidates that have been developed by Merck. And again, they're primarily currently focusing on their safety and tolerability and looking for biomarkers to measure their future potential.
Now, so what are the main focus points for the company?
Yes, there's a new management, and under this new management, we have plans to really transform the company to a leader in the anxiety space. We're focusing on social anxiety disorder, and we're in the process of planning what we call registrational trials or late-stage trials for BNC210. And we're in the process of drafting a package to discuss with health authorities in the United States on the content of the late-stage program. In addition to our efforts in social anxiety, we're continuing our efforts in another major area of interest in the post-traumatic stress disorder space. We have a large study ongoing, a large phase 2b study ongoing called ATTUNE, and we're on track for a readout mid this year. And we've also kicked off a number of potential partnering discussions, both on our clinical assets and preclinical assets. So a really and truly transformational year for Bionomics, starting from management to the foundations of the company, positive results from programs, interactions with health authorities, and potentially starting a late-stage registrational program for BNC210.
Well, Spyros, it's been fantastic talking to you. So thank you so much for your time.
You're welcome. The pleasure was all mine, Leon. Thank you so much for having me.
And now let's talk to AMP Capital Chief Economist, Shane Oliver. Well, Shane, what's your view about the inflation rate in Australia and the RBA?
Well, we in the last week, we saw some very good inflation numbers for Australia, which saw the headline inflation rate fall to 2.4%, and that's down from 2.8%. But more importantly, because we know that headline number was pushed down by lower electricity prices on the back of the energy rebates and so on. More importantly, the trim mean inflation rate, which looks at the underlying trend, fell from 3.5% to 3.2% and was only 0.5% in the quarter. So those things have increased the chance that the Reserve Bank will cut rates in a couple of weeks' time when they meet for the first time this year. It's not certain. There's obviously lots of uncertainties still around. You know, the Aussie dollar is very weak and been hit by Trump's latest tariffs. And of course, the jobs market is still quite strong. But I think on balance, the Reserve Bank will ease and probably thereafter adopt a cautious approach like you've seen from some other central banks. So it won't be meeting after meeting of rate cuts, and rates will still stay relatively high, but it does look as if we're heading towards a cut.
Of 0.25%.
Yeah, currently the cash rate is 4.35%, and we expect it to be cut to 4.1% in 2 weeks' time.
Right, okay. Now, you mentioned Trump's tariffs. Now, that's a completely new agenda, isn't it not, for the Federal Reserve? Because there's all sorts of talk of how it's going to lift inflation in the US and hurt the economy.
Yeah, Trump's tariffs are certainly a concern. They're not entirely surprising because he is known as Tariff Man, or he calls himself Tariff Man, I think. He did introduce tariffs in his first term. And he said that he's been saying for the last few months now that when he returns to office, he'll impose 25% on Mexico and Canada and 10% on China. And of course, that's what he's done in the last day or so. So he's just followed through with what he was saying he would do. To some degree, that was factored in. For example, the Aussie dollar has fallen about 10% from where it was back in September, when it hit 69 cents. And of course, at that point, it peaked basically when the Democrats in the US peaked in the polls and Trump bottomed. And then as it became more and more likely that Trump would win, and then he did win, the Aussie dollar has gone down along with that. So to some degree, the Aussie dollar and markets have factored in these tariffs, but it's not fully the case. And Trump's tariffs do add a lot more uncertainty to the outlook. Rough estimates suggest that it could add up to, depending on how the US dollar responds, could add up to 0.8% maybe to US core inflation. That's inflation excluding energy and food. Maybe lower estimates are down around 0.6%, but whatever it is, you will get an addition to US prices as a result of this. The question is whether the Fed looks through that or not. The Fed, I think, will be concerned that, if these tariffs remain in place, and they could still be reversed. Donald Trump, a week or so ago, announced a tariff on Colombia. Within a day or so, it was removed. So it's quite possible these tariffs could be removed. But if they're not, the Fed will worry that other tariffs will follow. Trump is talking about a general tariff on all imports. Through the election campaign, he put that as somewhere between 10% and 20%. He's talking about specific tariffs on things like steel, pharmaceuticals, various metals, semiconductors, and so on. So these things could add further to US inflation and therefore could see the Fed go on an extended pause. That won't necessarily stop the RBA from cutting rates, because the impact of tariffs on Australia is different. This is the US imposing tariffs. Unless we respond with tariffs and retaliation, assuming we're ultimately hit with tariffs as well, then there's not necessarily a reason why US tariffs would add to inflation in Australia. In fact, if anything, the risk for Australia is that it hits economic activity here, because less world trade as countries engage in a trade war will mean less demand for our exports, particularly to China, which means less economic activity here. Less demand means lower inflation in Australia. So a global tariff war kicked off by Trump could actually add to the case for rate cuts in Australia. But of course, at this point, it's wholly uncertain which way all of this will go. But we do know that Australian inflation on an underlying basis is around other countries' levels, and those countries have been cutting rates. And that, I think, supports the case for a cut, but obviously there's a lot of uncertainty around that.
The issue, though, with imposing tariffs on China, China's economy is troubled with its housing market and debt level, etc. So these tariffs could actually hurt China, which is Australia's biggest trading partner. So that could affect the Australian economy.
Look, the tariffs on China could certainly impact Australia. These tariffs, I should point out, have a massive order of magnitude compared to what you saw in 2018. Rough estimates suggest that it will take the average US tariff rate to 6%. It's currently about 2.5%, 3%. The tariffs back then boosted that average tariff rate by about 1%. They're only imposed on China. So these tariffs that have been announced on the weekend, 25% on Canada and Mexico, 10% on China, 5 to 6 times greater than the tariffs that were announced back in 2018. But this could certainly impact China. This 10% tariff on China is an additional 10% on the average 10% tariff that is already paid on goods coming in from China. Chinese exports to the US have been slowing down. They used to be something like 22% of total US imports came from China. Latest numbers down around 13%. So it's not as exposed to the US as it used to be, but it could still have a dampening impact, and rough estimates suggest that it could potentially knock 0.4, 0.5% off Chinese economic growth. Now, of course, the flip side is that we're still waiting for decent stimulus to come out of China, and maybe the Chinese have held that in reserve to see what Trump does on tariffs. And there could be more stimulus measures in China, which could partly offset that. But it does pose a risk to Australia. There's no doubt about that. And that partly is the reason why the Aussie dollar has fallen.
How do you see the Australian markets performing this year?
Look, I think ultimately it turns out okay. Because central banks ultimately will still be cutting interest rates. I think Trump probably won't go to the extreme in terms of his tariffs. Some of these tariffs will ultimately get wound back, but it could be a fairly rough ride along the way. We saw in 2018 when Trump announced tariffs that each time he did it, the US share market fell, and there was an echo effect in our market. And I suspect you're going to see weakness as a result of these latest announcements as well. And that's going to cause a volatile ride along the way. Flip side, of course, so that's the big negative, the tariffs. And obviously geopolitical risks are still out there. They're a factor as well. And there's a risk that this could trigger the long-awaited recession in the US. and adversely affect growth in other countries. So they're the risks. Flip side, though, is I think ultimately Trump pulls back a little bit. His tax cuts and other stimulus measures will help the US economy. Central banks ultimately still cut interest rates, and that will enable share markets to rise. But it's going to be a more volatile and constrained ride than we've seen in the last few years.
So investors can expect, volatile times ahead. And
I think it's certainly going to be volatile times ahead. You've got to bear in mind we've had 2 years of strong double-digit gains, around 20% or so in global equity markets over the last couple of years. And we've had 2 solid years in Australia. 2023 saw a return of 9 to 10% out of the Australian share market. 2024 was about 11 to 12%. So, you can't expect that to be sustained. More normal gains would be like 7, 8% or something. So I suspect that, after a couple of years of strong returns, we have to allow this is going to be rougher. It's going to be more volatile. I personally think that somewhere along the way we'll see a 15% plus correction in markets this year. Ultimately, it probably turns out okay, but returns are going to be a lot more constrained. You're probably looking at average returns out of shares 7% or so, not the big double-digit numbers we've seen in recent years.
so we can expect things to become more, shall we say, normalised.
Well, you could argue that we've had 2 years of outsized returns. Things might become more normalised. The risk is probably more on the downside than the upside, unfortunately. Donald Trump he's affecting change. I'm not altogether convinced it's positive change. Some aspects of his policies you could argue are positive. Smaller government, less regulation should be a positive thing in a longer term perspective. But tariffs are ridiculous. Tariff is a tax on trade. Best outcome, I think, is fair and open trade. And this is going to be a cost to Americans. You impose the tariff in the first place to provide an incentive to bring production back to the US. The only way you can do that is if the price of the imported good goes up, which is the whole point of the tariff. So Trump keeps telling us that tariffs won't add to inflation, whereas the reality is that, of course, it is a tax on imports, it is a tax, and that adds to prices. So it's going to cause a lot of volatility. So I'm not at all convinced there's good news in these tariffs. I think they're bad news. It's going to cause big disruption in the US. But obviously Donald Trump has different views, and we have to accept that.
And he's so unpredictable, so who knows?
Well, he's extremely unpredictable. We saw in 2018 that as soon as the share market took fright, which it did, from a high in September of 2018 to a low on Christmas Eve 2018, it fell 20%. Now, part of that was, of course, the interest rate hikes by the Fed at the time, and the Fed, of course, was concerned about the inflationary impact of the tariffs. But a big part of it was the disruption caused by his tariffs at the time. And, of course, as we went through 2019, he then had to back away. And he does see the share market as a barometer of his success. It's probably no surprise that he started these tariffs when the share markets were strong. But if they fall a lot, he'll start to conclude, well, this can't be too good. And then he'll likely back away. So that sort of gives me optimism. There is some guardrails around his policies. The other constraint on Trump is that he was elected on a platform to lower the cost of living. The reason several million people changed their vote from Democrat to Republican was because they were annoyed at the rise in the cost of living and the fact that they were worse off financially 4 years ago. So that those people are not going to stick with Trump if he just adds to the cost of living. We've got the midterm elections coming up next year. That's going to put a lot of pressure on Republicans if the cost of living starts to go up. Go down to Walmart and the price of your cheap goods suddenly becomes a lot higher, then ordinary Americans will get very concerned. So there are some constraints on Trump regarding tariffs, the share market, and of course politics. But obviously he could still have a rough ride before those constraints kick in.
Well, Shane, as always, it's been fantastic talking to you again this year, and we'll look forward to talk to you again. Thank you.
Sounds good, Leo. Thank you.
So what's happening in the news? Well, it's begun. Less than 2 weeks after Trump became US president, the White House has announced tariffs on Canada, Mexico and China. The Trump administration has laid the groundwork with what could become an intercontinental trade war. On Tuesday, the President announced he would impose a 25% levy on imports from Canada and Mexico, a 10% tariff on energy products from Canada, and an additional 10% tariff on China. On its Truth Social platform, Trump said tariffs will impose under emergency economic authority never before used for tariffs because of the major threat of illegal aliens and deadly drugs killing our citizens, including fentanyl. Don't ask if it makes sense, but this is US isolationism again. And if those countries retaliate, which they said they will, Trump has made sure the tariffs also include a retaliation clause that will increase penalties if a trading partner strike back at the US with tariffs. Now, these tariffs are historically important. They mark the first time the International Economic Emergency Powers Act has been used to impose tariffs. The last time the law was used was when President Richard Nixon used a precursor to the law to impose 10% tariffs on all imports in 1971. This act gives Trump broad powers and makes it difficult for Congress to overturn the decision. Legal challenges are likely, particularly on whether the measures are genuinely linked to fentanyl trafficking. But then, the next day, in a last-minute move, Donald Trump agreed to pause sweeping tariffs on Mexico and Canada for 1 month, after Mexican President Claudia Sheinbaum committed to sending 10,000 National Guard troops to the US-Mexico border, and Canadian Prime Minister Justin Trudeau pledged to send nearly 10,000 frontline personnel to ensure 24/7 eyes on the US-Canadian border. But we are yet to see what happens in a month's time. However, the trade war has definitely begun after China retaliated with a 15% tax on certain types of coal and liquefied natural gas from the US, and a 10% tariffs on US crude oil, agricultural machinery, large displacement cars, and pickup trucks. The measures take effect on February the 10th. Meanwhile, Trump has hinted the European Union, or EU, could be next to face tariffs pretty soon. They don't take our cars, they don't take our farm products, they take almost nothing, and we take everything from them. Millions of cars, tremendous amounts of food, and farm products, he told journalists. The US President added he enjoyed good relations with British Prime Minister Sir Keir Starmer and that trade issues with the UK could be worked out. Trump's tariffs, when they come into effect, are significant because economists say they would reignite inflation, which Trump campaigned to get rid of. And worse still, they deal a significant blow to the US economy. According to Ryan Sweet, chief US economist for Oxford Economics, the Federal Reserve's preferred inflation measure was 2.8% in December. This would rise to 3% by the end of the year. Sweet had expected the reading to fall to 2.2%, close to the Fed's 2% goal, without the tariffs. And he says the tariffs would also lower economic growth by 1.2 percentage points this year, from 2.6% to 1.4%. Why is this? Because higher costs would force consumers to reduce their overall spending, and likely retaliatory tariffs from countries affected would dampen US exports, and that would hobble American manufacturers and business. Trump's tariffs have sent markets into a spin, and the Australian dollar is likely to fall further. Concerns about a global trade war sent the Aussie to a 5-year low on Monday. IG market analyst Tony Sycamore said unless the dollar was able to regain territory in the coming week, it was vulnerable to testing. It could fall below the psychologically significant US 60 cent level before a move lower to US 57 cents. The weaker dollar is bad for travellers and people buying overseas products. If Australia is caught in the crossfire of a global trade war, it will cripple any hopes of an economic recovery. As expected, Trade Minister Don Farrell is seeking talks with his US counterpart Howard Lutnick as soon as it is humanly possible after the announcement of the tariffs to make sure they don't affect Australia. Still, he has to wait until Congress confirms Lutnick's appointment. And yes, if tariffs hurt the economy of China, Australia's trading partner, they're sure to have an impact here because it means China will buy less from Australia. And he better do it too, because dozens of major Australian companies will face higher costs and lower sales after the outbreak of a debilitating trade war between the United States and its closest partners. Exporters are now scrambling to evaluate the hit to their businesses from Donald Trump's sweeping new tariffs. Who exactly will be hit? Well, billions of dollars in pharmaceutical and family manufacturing exports could be caught up if the US President expands trade restrictions to Australia, with executives urging the Albanese government to seek exemptions in their discussions with American officials. Australian Treasurer Jim Chalmers says the government actually did modelling on what would happen if tariffs were imposed on Australia by the US before Donald Trump was re-elected. It found Australia would not be immune to trade tensions, but he said, "We can withstand it. When asked whether the government had done any modelling on if the tariffs were imposed on Australia by the US, Chalmers said the modelling found Australia was a very trade-exposed economy. It means that we're not immune when there are escalating trade tensions, but we're pretty well placed to navigate them, Chalmers said on ABC's Hour and Breakfast. There are two separate issues here. Tariffs applied directly to our economy is one thing. More broadly, there's an issue around escalating trade tensions. We won't be immune for that, but we're pretty confident that we can withstand it. He said he would not get into hypotheticals on retaliation. Meanwhile, US Treasury Secretary Scott Bessent has given representatives of the so-called Department of Government Efficiency access to the federal payment system late on Friday, handing Elon Musk and the team he is leading a powerful tool to monitor and potentially limit government spending. The new authority follows a standoff this week with a top Treasury official who had resisted allowing Mr Musk's lieutenants into the department's payment system, which sends out money on behalf of the entire federal government. The official, a career civil servant named David Librick, was put on leave, and what do you know, he then suddenly retired on Friday after the dispute. The system could give the Trump administration another mechanism to attempt to unilaterally restrict disbursement of money approved for purposes by Congress, a push that has faced legal roadblocks. Musk has been given wide latitude by President Trump to find ways to slash government spending. Musk has recently fixated on Treasury's payment processing, criticising the department in a social media post on Saturday for not rejecting more payments as fraudulent or improper. While their access was approved, the Musk representatives have yet to gain operational capabilities and no government payments have been blocked. The Department of Government Efficiency, or DOGE, is not a government department, but a team within the administration. It was put together at Mr Trump's direction by Mr Musk to fan out across government federal agencies seeking ways to cut spending, reduce the size of the federal workforce and bring more efficiency to the bureaucracy. Most of those working on the initiative were recruited by Mr Musk and his aides. Similar DOGE teams have begun demanding access to data and systems at other federal agencies, but none of those agencies control the flow of money in the way the Treasury Department does. And in the lead up to the election, access to opposition leader Peter Dutton has doubled in price to $10,000 plus over the past year as executives scramble to build relationships with the prime ministerial aspirant and his closest lieutenants. Business people are now paying up to $15,000 to be seated next to Mr Dutton at corporate fundraisers. They obviously expect he's going to win, or at least create a minority government. A boardroom lunch or dinner with Prime Minister Anthony Albanese costs much lower, between $6,000 and $10,000. And in another piece of news, state and territory governments around Australia have been warned by the big ratings agency S&P Global credit ratings could be downgraded. States and territories began spending more during the pandemic, but S&P Global says the spending is continuing after the pandemic. The pandemic is over, but pandemic-sized budgets aren't, S&P analyst Anthony Walker said. He warned that the consolidated cash deficit, calculated by combining the underlying budget balances of the states and territories, was forecast to hit $64.8 billion this financial year. The relaxed approach to fiscal consolidation is causing us to increasingly question our views that many states have exceptionally strong financial management on a global scale, he said. In the 2020-21 pandemic era budgets, which outlined how governments plan to move on from COVID era lockdowns and restrictions, states forecast a combined deficit to be $42.5 billion by 2024-25. That figure, however, S&P has estimated, is now not expected to be achieved until 2028-29. S&P estimates that would push gross debt above $850 billion by that time, or close to $1 trillion. As a result of increased expenditure and expected delays to budget recovery, Mr Walker said state and territory governments risk more rating downgrades after those related to the pandemic. And if that happens, it means all of Australia's states and territories would have to pay more interest on their debt. And Australia has banned DeepSeek from all government devices and systems over what it says is a security risk that the Chinese artificial intelligence or AI startup poses. DeepSeek stunned the world in January when it unveiled a chatbot which matched the performance level of US rivals. It claimed its version had a much lower training cost. The result, billions of dollars wiped off stock markets internationally, including in Australia.